Good afternoon. My name is Ted Everett, and I'm a member of CFA Boston's Programs and Education Advisory Council. Welcome. Joining us today is Vlad Golik. He is knowledge leader in McKinsey & Company's wealth and asset management practice and author of the firm's recent report, U.S. Wealth Management, A Growth Agenda for the Coming Decade. Before we turn to Vlad and his discussion of the report findings, I want to do a little housekeeping and highlight a couple of other events coming up. On Tuesday, April 26th, CFA Boston's Sustainable Investing Initiative will present a webinar conversation with Renee Jones about the SEC's proposed climate disclosure rule. Renee is the director of the Division of Corporate Finance at the SEC. The talk will take a deep dive into the proposed rules and the key areas on which the SEC is seeking comments. Joining her will be Stephen Rothstein of Ceres Accelerator for Sustainable Capital Markets. The accelerator has been a leader in the effort to spur action on the climate crisis as a systemic financial risk. Then on Wednesday, May 11, we'll be featuring a bookend event to today's talk. Elizabeth Nesvold of Raymond James will present Trends in Wealth Management and M&A, Tales from the Trenches. Liz will share a more anecdotal street-level view of the industry and what she is seeing in M&A trends from her unique perspective as a veteran advisor to the wealth management industry. Please check CFA Boston's website for the times and sign-up details. Okay, now on to today's speaker. Vlad Golik is a partner and knowledge leader in McKinsey & Company's wealth and asset management practice. He's responsible for McKinsey's annual wealth management benchmarking survey and leads development of McKinsey's ongoing perspectives on the state of wealth management industry and its key trends. He works with leading wealth managers, including direct brokerages, broker-dealers, wirehouses, fintechs, as well as retail asset managers and retirement providers, most of whom are all represented among you, the audience today. He focuses on topics including growth strategy, M&A, product management, distribution, advanced analytics, and operating model design. He has co-authored several of McKinsey's industry reports, including the recently released 2022 annual industry report. Prior to McKinsey, Vlad was in academia focused on theoretical physics. He holds a PhD from MIT and a BS and MS from Kazaryn Kharkiv National University, Ukraine. Now, final housekeeping items. We are recording this event and Vlad's report is available on McKinsey's website. There is also a link in the chat box to that report. We will be taking questions in the Q&A button, not the chat function, so please put them there as they occur to you. Vlad, welcome, and over to you.
Thank you, Ted, for the introduction, and thank you for having me. Very excited to be talking to all of you today. It's obviously a topic of passion for me, as you all realized from Ted's introduction. Maybe before we dive into the report, maybe I'll just start with a couple of things. First of all, what is it based on and where is it from, right? Because everybody has an opinion, so I just want to give you a little bit of sense what goes into the findings. We primarily use three sources of insight. One is our wealth management benchmarking survey, which is essentially a detailed P&L benchmarking across different types of wealth managers that covers half of the industry assets. So that gives us a very good sense into how the industry is performing economically, drivers, etc. The second source of insight that we use to produce these reports is our annual affluent and high net worth investor surveys, where we survey 10,000 individuals across the United States. And that also provides, as you can imagine, a wealth of data. And the last but not least is, of course, we directly engage with the industry leaders through our work, executive roundtables, informal sessions, etc. So all of this helps us put together a broader perspective on the industry, taking into account wealth managers' view, advisor views, client views, and executive views. With that, maybe I'll say one more thing before I project and start sharing some of the insights is since March 2020, since the COVID outbreak, which is of course first and foremost is a terrible human tragedy and crisis, the wealth management industry has entered an interesting phase of accelerated change. Over the past, before that, we would write these reports and we'd look what has happened in a year, and you would realize something has happened, but not that much. But the last 24 months have really accelerated a lot of long-standing trends, and that's what we'll talk about today. So from that perspective, those have been exciting 24 months for the industry and what's been going on. And I'm sure many of you have experienced that as well, just simply starting with a different operating model from home or digital, etc. So with that, let me project a couple of pages and share with you some of the findings today. So just before jumping into the trends and what will define growth for the next decade, a couple of highlights. The performance of the industry over the last 24 months has been a little bit mixed. It's been on one hand, the story of growth and health. On the other hand, it's been the story of some challenges. So on one hand, you have all-time high AUM, and these are end of year, as of January 1st, 2021 stats, but the story doesn't really change, hasn't really changed since then. You have record high client assets. You have record high net new accounts, both brokerage, but also net new advised relationships. You have very healthy pre-tax margins, despite all the tailwinds. But at the same time, you had the slowest 2-year revenue growth since 2010. You had 3 percentage point pre-tax margin decline, which is essentially profits dropping by 11%. And that was driven by a record high single year increase in costs. So it's a bit of a complex story, but it's sort of resiliency, but challenges as well. So with that, let me maybe share a little bit more insight, what is driving the economic performance of the industry and what has changed. And the story between 2019 and 2020 is the most telling, because between 2020 and 2021, not that much has changed. And I'll talk a little bit what we expect in 2022. So by 2019, the profits pools had been expanding for a couple of years for the whole US wealth management industry. And in 2019, it reached $54 billion. And it was driven, a lot of it was driven by actually rising interest rates and frankly, many wealth managers expanded their margins primarily due to higher interest rates on cash that sits in brokerage accounts. And then 2020, things changed. So you still continue to have growth from just organic net flows. You continue to have pretty strong market performance despite high volatility right after COVID started. You had continued shift to advisory, which I'm sure all of you are seeing in your practices, and then continued penetration of lending products among the client base as more and more wealth managers and advisors offer lending to their clients. But the big hit, and what really drove the profit pools down in 2020 and it created a bit of a paradigm shift, was one is interest rates going to zero created a major headwind to the profitability. So you see $4 billion in profit pools were wiped out just because of that. That goes back to my earlier point on a lot of firms' reliance on deposits for profitability. And then the other point I would make here is because of market appreciation and assets continue to grow, right, as we talked about market performance, and given that compensation is oftentimes tied to what we call compensable revenue, right, revenue that is investment fees and not banking, you essentially, wealth managers continue to pay out more in line with overall asset levels. However, that effectively led to a lower margin. So net, the industry lost 11% in profit pools between 2019 and 2020. In 2021, we've seen some growth, right? You, of course, had organic net flows coming in. You had ongoing shift to advisory, growth in lending, some market performance, etc. And now, as we are in 22, of course, with the prospect, we have essentially two forces. One is markets are volatile, and it's hard to predict what will happen there. But interest rates are expected to rise, which should provide a boost to firms' profitability, just given that those revenues typically come with very low marginal cost. So that's a little bit of the economic health of the industry and what are the drivers of it. If we were to move on and just thinking ahead beyond just the pure economics, what are the trends? What are the things we see that will define the growth narrative for the industry for the next decade? Although, given how fast things are evolving, I would probably say next 3 to 5 years. And we've structured across 4 dimensions. It's the fast growth segments, it's new needs, it's new products, and it's new business model. And let me talk through each and one of these briefly, and then I'm happy to go deeper depending on the interest. So in terms of fast growth segments, first one we highlight here is women. And the reason why this is a large and fast growth segment, there are a couple of factors going in here. One is due to social changes, over the many decades, we are at a point where we have a critical mass of women who are high earners, who are more independent, and they need all the same services as anybody else. So as the population growth in the U.S., it becomes one driver of the rising importance of women. The other piece is more around, as you all know, the vast majority of assets is concentrated with baby boomers. And typically in traditional households, men are older, men live less, and the intergenerational transfer we've been talking about for so long, and people talking about millennials inheriting money, first, typically, not of course always, and there are different constructs. Oftentimes, it's the wife in a traditional household that would inherit most of the assets, and which means that by the end of the decade, women will control the majority of investable assets now held by baby boomers, which is 30 trillion total, which is a huge number. And the implication for it is there are several implications, but as we look at the needs of women, and again, there are multiple subsegments, but on average, it's a segment that is more interested in planning, less interested in risk taking. And again, these are some of the stereotypical things you would say, but our research suggests that it does tend to be skewed that way. And the way I think about the needs of women when it comes to wealth management, women stand for all the right things, right? It's about planning, it's about getting things right, versus necessarily taking short-term risks for quick gains. That's number one. Number two is around engaged first-time investors. The headlines of the last 24 months have been a lot about direct brokerages, millions of accounts opened across digital startups as well as traditional brokers. And the increase has been incredibly high. And we talked, and there've been a lot of talk about democratization of investing with free trading. And by the way, the number of new accounts has opened in 18 months since COVID was around 25 million, which is really high. The question becomes really and many of these are first-time investors. And the real question becomes, what is the next set of services and products that they would need? Because trading stocks, depend by, reading Reddit, it's fun for some time, but at the end of the day, these people who have, and those who have real assets to invest, the question is, what is the next type of product or offering they would be into? It's probably not, full-on advisory, but it's something in between where they can still express their interest, but at the same time get some guidance. So this segment is interesting, and I think there will be a lot of innovation around trying to go and serve this segment in new ways. The third segment I would highlight here is hybrid affluent investors. So the stat here, which is quite interesting, is that 50% of affluent investors, which we define as investors between $250,000 and $2 million in investable assets have an advisor and a self-directed account. And among affluent investors, this is the fastest growing subsegment. So essentially, people have an advisor relationship, but they also put aside money in self-directed brokerages where they can have it as play money, or they want to keep money outside of their advisor's purview. There's a bunch of reasons why people do that. But what's important is that as clients of advisors put away money into self-directed offerings, it essentially creates a competitive threat for advisors, because then those self-directed offerings, they themselves are interested in deepening those relationships and moving them into advisor relationships. So we have this interesting dynamic where, different types of firms are essentially competing for the same type of client now, which is not something that we would have seen 15 years ago. And this is just a part of the broader theme that over the last 5 years, we've seen blurring lines between different models, where there were specific swim lanes for different models in wealth management. And now it's a little bit of almost everyone going after almost everyone. So the competitive intensity has really intensified and has become cross-cutting. So that's on fast growth segments. On the new needs, so first one is personalization, and personalization can mean a lot of things. And when we survey investors, they say that personalization is one of the top 3 satisfaction criteria or factors for them when they have a wealth management relationship. The reality is that, and I'm sure as all of you in your client service, you personalize your approaches to your clients. Everybody has a different circumstance. But what we see as the next wave of personalization is personalization of investing. And that comes or started coming in the form of direct indexing, separately managed accounts, which we expect to continue to grow quite rapidly, 3 times growth between 2020 and 2025, where investors can express their views. That's number one, which is more important for the younger cohort, but also personalized in terms of outcomes and what we call tax alpha. So this has been taken off. I'm sure you've seen the headlines. Probably every major asset manager and wealth manager has acquired this capability, and those who haven't are building it. So we expect to see a lot of competition for advisors' mind share on the topic of direct indexing. The other piece that we'd like to highlight on new needs is omnichannel access, and we've seen shift towards digital over many years, but it's dramatically accelerated, of course, during COVID. I'm sure all of you engage with your clients remotely for how many months, what you will see in the broader report, which I believe Ted and team posted the link to, the role of branch is decreasing in terms of different stages of the client journey, whether it's account opening or relationship onboarding, whether it's just financial planning conversation, whether it's account maintenance, etc. So the role of branch is decreasing, and the role of digital, which is self-serve, or remote, which is either by phone or video chat or whatnot, is rising. And it's not that there is a segment that wants digital only, or there is a segment that wants remote only, or there's a segment that wants branch only. It really differs depending on the specific activity, which essentially means that wealth managers need to be able to provide this seamless omnichannel experience across, essentially being able to jump across channels depending on what client prefers. And as a bit of a feedback from the clients, we heard that 50% of them think that their primary wealth manager should improve their digital capabilities. So that's on the omnichannel access, and I'm happy to answer questions during Q&A. The last piece on new needs is integrating banking and wealth. And again, we've seen this trend of people wanting more and more to bank and invest in the same place. And over the last 24 months, we've seen a huge jump in the numbers. So one stat I'll share here, and again, there are many more other cuts in the broader paper, is that 53% of younger than 45 investors with more than $250,000 investable assets prefer to consolidate banking and wealth relationships versus only 20% in 2018. So over the course of 3 years, 2.5 times jump. And the primary reason for that is essentially convenience. Convenience in the sense of being able to have integrated digital experience, having one dashboard across the balance sheet, and frankly, just having only one website and dashboard to look at. So it's really driven by convenience, and that's where banks are better positioned than wealth managers to win in that segment, which is essentially most of the under 45s, because they have robust banking capabilities, and historically has not been easier for wealth managers to build out banking capabilities at the same level in digital maturity. So that's a major, I would say, development, and that we call it new needs, but it frankly has implications on new products and new business models. On the new products, two products to highlight, and I'm sure it's not going to be news to anyone on this call. One is private markets within retail, and by retail we mean not institutional, which is essentially affluent, high net worth, ultra high net worth. The allocation to private markets has been relatively low, around 2% of total assets in 2020, but we expect it to grow to 3 to 5% by 2025, which is corresponds to 1.5 to 2.5% increase in allocations. And I think there are a couple of reasons behind that. There are a lot of reasons behind that, actually. First of all, there is, just from the portfolio construction standpoint and broader institutionalization of retail investing, it makes sense to increase allocations to uncorrelated asset classes and new sources of yield and returns. So clients, from the client service, it makes sense to guide clients to increase allocation. The second point is that asset managers, alternative asset managers who have been quite successful in the institutional segment, are now investing heavily to build out retail distribution, to go to advisors, home offices, and essentially start creating additional supply for retail investors, because in the past it was primarily for institutional or very ultra high net worth. And the last piece, what's contributing to this growth, is the emergence of infrastructure providers who essentially provide technology platforms they can easily plug it into home office systems or custodians or turnkey asset management programs, and deliver the alternative products, funds, and being able to actually maintain them. Because it's not the same, obviously, to offer a private markets fund on your platform as to offer, mutual funds, ETFs, or stocks or bonds. So that's on private markets. The other piece on new products I would like to highlight is digital assets. Again, this has probably been more in the news than any of the other trends we've talked about here. 73 million of verified users on the largest crypto trading platform. This was a status a few months ago. It's probably more now. It's a highly volatile market, which is not a bug, but a feature, because it constantly attracts attention of people who are invested. And the reason why it's important to pay attention to it is twofold. One is the asset class is too big to ignore. It's more than $2 trillion right now. The second reason is many of your clients are either investing in crypto elsewhere or have latent demand for it, meaning they would like to invest had they had an opportunity. And it creates a real challenge for traditional wealth managers, because offering crypto has a bunch of technical challenges. It has a bunch of regulatory challenges, right? There is no clear framework, but at the same time, that's where the flows go. So the question is, to what extent people are ready to take risk and offer something, maybe through white labeling, versus just seeing others capturing assets of new clients and their own clients. So that's on digital assets. On new business models, a couple of things to highlight here. One is RIAs and services to RIAs. Obviously, RIAs have been the fastest growing advisor-led offering. And the revenue growth in the segment expected to be 2 times faster than the industry overall. So 10% revenue growth is what we project for the next 5 years. And because it's such a large and growing revenue and profit pool, of course, wealth managers, asset managers, and other ecosystem participants want to participate in this growth. And recognizing that it's hard to stop the flow of advisors, the migration of advisors to the channel, the firms or the ecosystem participants are trying to find ways to provide different services to RIAs to essentially capture a part of their expense base. And that comes in multiple forms. It either comes through asset management, which is TAMPs have been around for quite some time. It comes, custodians obviously have been around. These are more like traditional ones, but also we see non-traditional entrants who either provide banking solutions, white label banking solutions to RIAs, and that ties back to the banking theme we talked about before. It can also be tech point solutions. It can be a broader tech platform with APIs. So there's a lot of innovation, and some firms who used to be focused on retail offerings, such as simple as robo-advisors, are actually now developing more integrated value propositions for advisors in partnership with other fintechs. So there's a lot of activity on how to essentially be a provider or a vendor, whether it's banking, asset management, or technology to RIAs. And then the last one I would highlight, and then would open up for questions, is around digital advice models. What we've seen is a pretty significant increase in comfort with digital only, which is quite interesting because in digital only, essentially, it's robo, right? Robo advisors have been around for quite some time, since 2012, if I'm not mistaken. They gained some assets, but it has not been this dramatic disruption that many or some had predicted back then. And the primary reason was people were just not as comfortable to not have a person to talk to. Counterintuitively, and I cannot explain it, but we've seen a 60% increase in comfort with digital only robo models, and 21% increase in comfort with the remote models in the last 3 years. With remote only, it's intuitive. It makes it's understandable. People have been engaging with their advisors remotely, and they don't need necessarily have a branch to go to once in a while. Probably goes without saying, but this has been primarily driven by younger segments. So this is, maybe just to step back, this is our best attempt to outline what the next decade growth themes might look like. As I said in the beginning, the industry has evolved rapidly over the last 24 months, and I'm sure new themes will evolve and emerge, and some of this will not be right. We don't have a crystal ball, but based on all we see, this is our best guess. So with that, maybe we could start moving to M&A. Sorry, to Q&A.
Q&A, okay. There's a lot there. Let me first say that, folks, if you have questions, put them in the Q&A box. It's easier for us to track them there than the chat box. Let's start, because we have a question about the RIA model. The rise of this, the migration of advisors to this structure, where are they coming from? Why is this growing twice as fast? Can you give us a little color on that? And who will win basically from this surge into the RIA structures?
Yeah, so the transition to RIAs continues to be primarily fed by wirehouses. Now, there's a bunch of other models that, you have IBDs, you have regional broker dealers, that also happens. But wirehouse will be the largest driver. I don't think it's majority. I'm not sure. I don't remember the total number, but it's definitely the largest. The primary reason for this continued growth is really this sustained advisor migration. And as we look at the average advisor age, which is in mid-50s, and retirement that's going to come at some point, and we look at in this current market, right? 5 years from now, things might be different. The market for RIAs has been very heated, but if you look at what's the best way to monetize your book, whether it's by being in a wirehouse or going to an RIA and then selling the business for high net worth advisors and larger advisors with larger books, there is definitely a multiple arbitrage on book. And I think many recognize that. So the continued migration.
But again, migrating from mostly the brokerage model.
Yeah. Well,
okay.
not brokerage model.
I think, wirehouse.
Yeah, exactly. Wirehouses offer a lot of fee-based, and I think it's majority fee-based now.
Okay.
Yeah. So it's the advisor movement
and
as a primary driver, and organic growth on top of it, because there are custodial programs, referrals. There's billions of dollars being sent to RIAs every year by large custodians as well. That helps.
So is this still a largely atomized market? Are there several players? Consolidation has been happening there for a long time anyway, especially with this transfer from generation to generation issue of how do you succession issue.
Yeah.
So kind of who are the players just generically, and are there dominant players?
Yeah, so we see two effects, or two trends. We see a fragmentation at the bottom and consolidation at the top. And as you look at the market share of top 10 RIAs, I believe it almost doubled in the last 7 years. So you will continue to see this ongoing consolidation. Multiples are very high and very attractive to the sellers, not to the buyers. And we'll continue to see that, because in the end of the day, there is still, in the current market environment, there's still a multiple arbitrage where just simply larger platform commands a larger multiple. And with that, it creates an incentive for investors to come in and actually be quite aggressive about buying up assets. I think the question becomes, what's the end state of this? I would expect over the next 5 years to have national platforms that will be in the league tables of larger wealth managers in the US, not necessarily in, $500 billion, but in a couple of hundreds billions of dollars, we'll have several.
And then at the small end, it's so easy to set up shop with the outsourced tools.
And it's easier and easier and better and better. Right. And I do think the other angle, there are firms, I'm not going to call names, but it's all in the public domain, who are really trying to build high net worth platforms tailored to high net worth, ultra high net worth advisors. Because what happens now is when advisors move away to RIA, it actually takes a fair amount of effort to set up a proper platform to serve more sophisticated or wealthier clients. And I think as more and more firms try to offer the services to RIAs, as I was talking about, they start opening up some of these capabilities that were in the past available to their internal advisors. They start opening it up, essentially making it even easier for advisors with larger books, wealthier clientele, to actually move.
That's actually a good segue to my next question, which is about the personalized investing, the whole direct indexing. How is this playing out in the high net worth space? And it strikes me this is like the robo capacity that at first was seen as a separate industry, a separate competitor that all of the incumbents basically adopted in some form. Is this going to be table stakes, having this direct indexing capability for all the players, particularly at the high net worth level?
Look, I mean, SMAs
maybe it already is, because I don't know who's left to be acquired out there.
I think there are a couple of things going on. So I think there are asset managers who are trying to find ways to add value, right, and increase their revenue pools. There's been a lot of fee compression on products, ETFs, rise of ETFs, all that obviously had an impact. So direct indexing does look like an attractive, fast-growing opportunity for asset managers. And even those wealth managers who bought it, they bought it for their asset management arms. So I think you have two things. You have one is D2C, and there are D2C firms who are trying to offer customized investing, which is separate. I would not look at it the same way as the advisor market. Within the advisor market, I think it's going to be table stakes for an advisor to offer, or the firm to offer direct indexing capabilities to clients. Now, the challenge is right now, direct indexing is maybe let me take the high net worth question first. SMAs have existed for quite some time, so it's not anything new. I think it's more bringing it down market. right? With fractional shares, no cost, zero fee trading, etc. I think the direct indexing right now is in early innings, even in terms of technology and what it does. Right now, you essentially have an account and you can do a lot of great things with it, but it doesn't help you to think about tag customization across the full spectrum of holdings, right? It's only the account that you have and look at. So I think kind of direct indexing UMA, I think that would be very interesting. I just don't think the technology is there yet, but being able to actually implement overlays, tax optimization across the full holdings, across different accounts, and maybe different providers, I think that's the holy grail, but it's difficult. So I think that would be one part of the innovation that I would hope to see. And then the other one would be around, frankly, digital interfaces. Right now, it's sort of this tool that advisors have, but being able to engage clients on it in an intuitive way, thinking about apps you have on your iPhone that clients can actually play with it, understand the risks, understand the limits, options. I think that's interesting because it becomes much more engaging, and that I think the value that could be provided. Now, the question is who's going to provide it? Is it wealth managers who can build this type of solution? Is it asset managers, or is it turnkey asset management platforms who provide platforms to advisors in the RIA market and broker-dealer? I'm not sure who will win this, or it's fintechs and it's going to be plug and play. I'm not sure, but I think that would be the next, because that way clients will actually feel that this is personalized experience, it's fun, versus just a conversation with an advisor and then something happening on the back end.
So you need the user experience designers at Robinhood to get working on this. So you have a really colorful game-like interface. Oh, that's interesting. Again, I think we're talking about direct indexing, but I think it's the larger enabling tax efficiency technology that we're talking about, because what's really led this or the growth in that is ESG investing and factor investing. But again, like the robo technology, it really is just a tool that you can do a lot more with than it seems on the surface. In fact, I sort of look at direct indexing as a way of salvaging active investing. It allows brokers, it allows advisors to say, hey, you need me in there managing this more actively. So I guess the question is sort of a first derivative. What effect will this have on who drives the investment engine? Who makes the investment decisions? I can see why a Morgan Stanley or somebody wants to bring this in because it lets the brokers manage to a model, but somebody's got to actually make the investment decisions, where some of these are active. And even with the passive index, you've got these tax decisions to make unless you all farm it out to an AI agent anyway. So who do you think, where does the investment engine work get done?
Yeah, I think it's a great point, because I do think kind of it's one thing to invest clients' money in a home office model or third-party model. It's another one to start actually tinkering with it and understanding implications. And it has obviously fiduciary risks, et cetera, et cetera. So I think that's sort of the other part of the equation. The way I would think about it is you would have advisors as sort of the first line of defense, and then you would have specialists supporting at the home office level, similar way how you have with many things like structured products or alternatives, a bunch of these. But I agree with you. It's not, I think the idea is neat and it makes sense, but I think the implementation and execution, I think the first two things I mentioned as a limitation, but also what you're saying is the investment decision and understanding the implication, even at the advisor level, is going to be very difficult. So I think, and frankly, look, the other way to look at it is asset managers can provide that help, right? As a product support, essentially, right? So I think maybe the more I think about your question, I think it depends who wins this battle for advisor desktop, who is essentially the direct indexing provider. If it's a white labeled or an in-house solution of a wealth manager, then it will be home office. If it's a asset manager, it would be more like, product support.
It strikes me that you'll see more specialization where the advisors need to farm it out to asset managers because they don't they need a model they need to execute, and they're focusing more on customer relationships.
Exactly.
The technology folks want to come in because they can help manage that better. So you've got, maybe everybody's got a piece of this.
Yeah, it's not easy, right? And I think we will see continued growth in the current construct the way it is right now. But if we talk about direct indexing becoming the next ETF, I think it will take probably more than that.
Right. Well, again, because it does so much more. It's like robo-advising. It's not really a separate product. It's a technology that has much wider implication than it appears on the surface. I mean, right now it's really being used to push ESG and factor investing models, as well as the passive index. Interesting. Another question, and I'm just going to check here, see if we've got folks weighing in. I don't see too many questions yet, but and I would encourage folks to put them in the box as you have them. But coming to the omni-channel and the blurring of banking and investing, I'm wondering how this works at the high net worth level. At the affluent level is where you've sort of noted some of the trends of the blurring. But at the high net worth level, the stories you always hear are next generation wants nothing to do with dad's bank or dad's investment manager, and they want to go off on their own. Where you've suggested the banks are making inroads because I'm guessing the younger generation has come in through a bank or a neobank, and they just want to blur it across to the investing services. How is that working at the high net worth level versus the affluent level?
Well, I think it's first of all, I think it's the function of age, right? First and foremost, I think you're right. It's more about being digital native. It's coming from a bank. Many banks offer already dashboards across investing and wealth. So I think that's the main reason behind the trend. Now, your point about high net worth. I mean, the reality is that high net worth have historically had, and again, on average, high net worth are older generations, right? So high net worth historically had access to there's this interesting dynamic that psychologically older generations think of investing and banking as two separate things. That's number one. Number two, they do like to diversify, because if they've gone through multiple types of crises throughout their life, they've obviously gone through 08 or 09, where they had money, not just being there physically. So I think there is for older generations, there's this desire to diversify across multiple places, and also when many of the wealth managers, wirehouses, have been offering securities-based lending, mortgages for quite some time. Obviously, not everybody, but it's been already offered. So it's not that, it's almost like they maintain status quo, and then also the status quo is supported by their beliefs about safety of their assets and banking being a separate thing, and they can never think of somebody who invests helping with checking account. It's just it's not necessarily how they perceive this. Now, the younger generation is very different. The younger generation does not think of investing as, with advisors like stock picking and creating alpha. It's a very different, it's more about how do I maximize, how do I reach my goals in my life? Obviously there is a, trading segment, let's set it aside. So I think it's very psychological and where people are coming from. And I think high net worth clients who are younger, they want similar things as affluent younger investors. And look, they might appreciate a relationship-based pricing. On top of them, they might be more sophisticated in their needs beyond just having one dashboard. They might need more sophisticated investment options, which banks are trying to offer, right? Moving away from, many years ago, closed architecture mutual fund platforms to something, more modern. But I think it's really the primary axis here is age.
Well, it's interesting because that almost contrasts with the other phenomenon of the hybrid investor who has an advisor and a directed account. So they want them separate or they have them separate, but maybe it's just because one provider doesn't provide both of those.
So that's one reason why that's happening, exactly because there are not that many providers who can actually offer all of it, and as you see, many providers are trying to start offering more and more, but also people just like to have play money outside that other people don't see. I think there was a good research on this topic. There was an article about it, the reasons why people set money aside, and it's a lot of idiosyncratic reasons. Again, so it's not, and these money are almost treated differently psychologically. Of course, you have very sophisticated investors who say, I don't want to pay advisor for beta exposure, and I'm just going to put, but that's a minority of people.
Right, that understands that. Couple questions here. What is the direction of direct indexing given the lack of access to foreign market stocks, which make up half of global equity capitalization? Is there an attempt to really broaden that? Obviously, that's that much more complicated to track and manage from a back end standpoint. Is there?
Yeah. I look, I think you're right. I think it's going to be some time before. I guess it goes back to the point I made earlier that now direct indexing use case is small, and I think people are looking at it from multiple directions. One is the international inclusion, the other one is inclusion cross accounts, and then the other one is obviously around actual delivery of it. I expect a lot of innovation here. People are putting real money behind it, and it is perceived by many that this would be the next source of how to make up for the loss of active fees, essentially, right? So I think there is a lot at stake, and it will come eventually. Is it going to be 1 year, 2 years, 4 years? I'm not sure. I think it will probably start expanding into larger markets, like European markets. Asian markets are more fragmented frameworks, regulatory frameworks. Obviously, China is complicated, so probably that would come later. But it's certainly the direction of travel.
Mm-hmm. Question here. I will read it directly because there's a little bit of an editorial in it. But are private market investments the next unlisted REITs attractive to wealth managers because of upfront fees, with the facade of less volatile returns because of the pricing of illiquid investments?
Well, I think up until now, on average, private markets have generated strong returns net of fees, right, to everyone. So, and that's why you see their adoption by institutions. Right. And institutions have a lot of consultants, gatekeepers, fiduciary responsibilities. I mean, there's a lot of checks and balances there. So, and the fact that institutional investors expect to allocate more and more suggests that that's the expectation, that these returns net of fees will continue to happen. So that's the primary reason why we're talking about for retail, because now you have more supply of these products. Now the question is, can you maintain returns when your supply goes up? When you start underwriting a lot of deals, a lot more deals, is the quality of underwriting is as robust? Are you actually getting into deals that you wouldn't otherwise, but because you need to raise a fund? That's a separate question. Nobody knows. We'll find out. I think that's what you're alluding to. That's what the person who's asking the question is alluding to, and that might be the case. We don't know. But there is definitely a risk for private markets managers to be able to replicate historical returns when they invest in a much larger universe of deals.
Very complicated. And certainly we'll see what the fees come out at the retail level when the products are fully formed, I guess.
And just one thing, I don't think private markets are immune to fee compression. I think we've seen some of it, and it will be.
Yeah. Question going back to one of the segments that's growing quickly, women being one of the fastest growing segments. Can you offer any, I guess the question is does research, how do you take advantage of that? Does your research show any preferences on the part of this group for who their advisor is? Basically, do they prefer their advisor be a woman?
Yeah, so it's interesting. Yeah, we actually had a paper, and maybe I can share it later, and you can distribute to the group on women investors is the next source of growth in wealth management. It was from 2020, and as we look at preferences for advisors, not really. At least in a self-reported way, women don't say, I want a woman advisor. Like, it's not like a general question we ask the full population, do you want your advisor to look like you? And the answer, it's like number 8 or 9 consideration when choosing an advisor. Now, it's self-reported. What people actually feel might be different. We don't know, but that's what's self-reported. I think in terms of practical, what you do about it, I think what we find is that, and I'm sure many of you have seen this, oftentimes when the husband passes away and the woman in the household, gets in control of the assets, oftentimes advisor had not talked to her ever. And of course, having not talked to somebody for like 30 years, the person is not going to be incredibly loyal to that advisor, and she's going to be, I want my guy or my girl or whatever. So I think being more inclusive in your client service proactively. And sometimes, look, and sometimes the head of the household, the male, again, I'm talking about traditional households, might not want that and might say, oh, no, it's fine. But actually building that relationship is very important. A, for better outcomes for the client household, and B, frankly, for the success of your own relationship over longer term.
It mirrors what's going on in the generational transfer question. If you never talk to the kids until the first time they get the money, you're not going to keep that relationship. Yeah. And let's see, we got one more here. How would a severe and prolonged bear market change some of these trends? Obviously, the revenue and fee coming from the market appreciation goes away, but what other impacts might that have on these trends?
You know what's interesting? We modeled out, we modeled out performance of the industry under different market scenarios. And unless you have a market correction of sort that will continue, and the market will stay flat, for a very long time, then you will have obviously some issues. Now, what happens in practice, you have market goes down for 1 quarter, 2 quarters. I mean, again, you can have different types of prices, and then it goes up. But the way the fees are calculated, it's on average assets across quarter. So there are a lot of these like hidden cushions for the industry to land on. And you really need to have a pretty bad scenario when your profits really drop by, if you have like 08 or 09, of course, that's not great, but it's still not that it's not lethal. And in 08 or 09, it was more like run on the bank versus actually fee-based revenues going away. So with a fee-based revenue, it's actually very resilient. And that's why investors, public markets investors who invest in wealth managers, they really like these fee-based revenues because they command premium versus more like chunky transactional revenues. So I think from that perspective, the industry has a lot of munition against that. Now, what happens? Obviously, you will have your clients calling you more. I think omnichannel becomes more important, so you can actually have a broader reach. You as an advisor can have 2 times as many conversations. You can scale your practice. I think that's number 1. Number 2, more and more conversations will happen about private markets, because private markets obviously do not have, mark to market every second.
Right, a 10-year tail.
Yeah, exactly. So I think allocations, okay, if there's no alpha here, is there alpha there? So private markets will rise in their importance. Obviously, there's going to be a bunch of tax conversations, like what do you do now? Do you take advantage because you had a long bull market? So right. I think that as well, tax loss harvesting. And so I think it will change the nature of conversations quite a bit. It will go it will probably pivot from, and then you frankly will have all the financial plans you've put together. And then now you need to see, well, does it still hold water? How do we need to change? So I think it's going to be almost a more protracted version of what happened in March and April 2020. But I don't think that the actual economics of the industry is going to be hit in a major way. It's a very resilient industry, the way it's structured right now.
So in fact, most of those trends, it looks like would if not be enhanced, it certainly, they wouldn't be hurt by it. I guess the only thing you'd see is capital budgets spent on technology, upgrading, making changes where you might think twice about it because revenues are down.
Yep.
Yeah. Okay. Well, we're coming up on the hour, and I very much appreciate your joining us today. I think we will wrap it up here. I know you have a hard stop at 1, but I want to thank you for presenting today and remind folks that that study is available. The link is in the chat, and if you can't grab it before we go, reach out to CFA Boston staff and they should be able to connect you. Also, I want to thank all of you for coming today, and with that, we will sign off.
Thank you for having me.
Very much.
I appreciate it. Thank you. Have a good day. Bye-bye.